Good afternoon, and thank you for joining us today. I'm Bruce Tatters, the CEO of Red Cloud Securities. Today's webinar features Seabridge Gold, the premier gold and copper exploration company out there in the space today. The majority of its projects in either Canada or the US. Seabridge ranks number one in gold reserves per share and number one in gold resources per share among the North American listed gold companies. And thanks to KSM, Seabridge's flagship project, Seabridge also ranks number one in copper reserves per share among major listed copper gold companies. We are extremely privileged to have Seabridge here to update everyone on their progress during 2021 and their plans for 2022. Today, I have with me two members from the Seabridge Group. Rudy Franck, co-founder, chairman, and CEO, and Jim Anthony, co-founder and significant shareholder. Jim will provide an outlook on the gold market, followed by Rudy, who will provide an update to investors today on Seabridge's plans going forward. After the formal presentation, we'll be taking questions live. Please send us your questions via chat, and we'll get to as many of them as you can. You can type in your questions in the chat box at any time. I remind you that both Jim and Rudy will be taking questions. So whether they're commodity questions for Jim or whether they're Seabridge questions for Rudy, we're going to get out all of your questions for you. To start, we'll handle disclosures and get to it. For Seabridge Gold, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of the presentation. For Red Cloud, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell. And we note that this call does not take into the particular situation for individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for Seabridge Gold for specific disclosures. So now I'll turn it over to Rudy and Jim, and we'll have Jim begin.
Thank you, Bruce. At Seabridge, for the last several months, we've been talking about the two shoes theory of a gold bull market. And so we'll start talking about that now. We're looking for two shoes to drop for the next gold bull market. One of those has dropped, and the other is about to. So next slide, please. The first shoe, which has dropped, is inflation is no longer transitory. Thank you, Jay Powell, for finally admitting it. And this is now, I think, increasingly recognized across the investment universe. You can see from Powell's comments that risk is now much more likely to continue, that we're seeing the attempt to accelerate tapering in the next meeting later this week. The US annualized inflation rate, as you can see in the chart below, is rising rapidly. It's beginning to accelerate. And it's not a problem. It is a problem for gold right now because the probability in the market is that we're going to see 3 rate hikes by the end of next year. And therefore, if the Fed is going to deal with inflation, why would you want to own gold? So one shoe has dropped, the next is to come. Next slide, please. The second shoe to drop is when we figure out that the Fed doesn't raise rates, and that's coming soon. Why won't they do that? For the same reasons that they had a tightening process thrown back at them in the third and fourth quarters of 2018. What we have at the moment is inflation in the economy and the increasing signals of deflation in the financial system due to the Fed threatening to raise rates. So what are those signs? Well, the dollar is up. The yield curve is flattening dramatically, resisting an expected bond rout. The euro-dollar curve is starting to invert, and that's a serious one. The extraordinary volatility in stocks and bonds, that we've had this month 6 out of 7 successive days when the Dow moved 1% or more up or down. We've had the rockiest 30-year Treasury bond auction in a decade, also in December. We've had a 1-week 30% drop in liquidity correlated Bitcoin. And we've had a crash in the Turkish lira, which is another currency like the US dollar that has twin deficit, trade and budget. So if you look at some of the charts and graphs we have here, the first one is a Bloomberg index of liquidity for the Treasury market. As it rises, it means liquidity is falling. You can see that it's beginning to tick up. US government securities are becoming harder to trade. And then below, you can see that the spreads are starting to blow out between corporate bonds, particularly the lower grade ones, and treasuries. These are signs of declining liquidity, or deflation, in other words, in the financial market, which is to be distinguished from inflation in the economy. Next slide, please. So this is no time for a regular rate hike cycle. And the reason for that, very simply, is that the debt to GDP ratio is not conducive to any kind of rate hike cycle. The last time we had debt to GDP ratios similar to this was at the end of World War II. And you can see that in the graph on the left, that was the last significant peak in the debt to GDP ratio. And subsequently, due to financial repression at that time, the debt to GDP ratio came down, and we got back into regular rate hikes when required to deal with inflation. That's no longer the case. If you look farther along in that chart to the left, you'll see that the debt to GDP ratio is predicted to go right off the map. That's a CBO, Congressional Budget Office, prediction based on the current rate of expenditure and the growth in the economy. The last time this happened, after World War II, the Fed and the Treasury decided that financial repression was the way out of that, and they inflated the debt away. We expect that to occur this time as well. And if you look at the chart on the right, then you can see the orange line that, in fact, negative interest rates based on the real rate on Treasury bills went to minus 14%. Currently, we're around minus 5%. So we've got much further to go. The Fed is going to embrace this, in our view, because they have no choice. Next slide, please. So the second shoe, we think, will drop in early 2022 by way of continuing financial repression. Nominal growth rates must therefore exceed the rate of debt increase. So, in other words, inflation must run above interest rates. Dollar will lose substantial value, and gold will re-enter a bull market on the way to new highs. And debt to GDP, which has already dropped from 135% to around 125%, actually, I think now 128% as of this morning, thanks to 6.8% inflation, will need to get down to around 70%. That's a long ways to go. It's lots of inflation and the recognition that the Fed is encouraging that inflation, even if it doesn't say so. So on that basis, we think we're very close to a second shoe dropping and another gold bull market. Rudy, over to you.
Thanks, Jim. Just more compelling on why owning a lot of Seabridge shares makes a lot of sense if we're right on our look going forward. So thanks for the opportunity of presenting today. As Bruce mentioned, I'm the co-founder and the CEO of the company. I've been in that position since we started in 1999. When Jim and I formed the company back then, our goal was to create what we thought would be the best leverage play to a rising gold price. And the most important guiding principle we've been following from day one is to provide our shareholders more gold per common share than any other company on the planet. And we do that through the concept of simply growing ounces in the ground faster than shares outstanding. And as you can see on this long-dated chart here, we've delivered on that concept. Today, before our year-end estimates on updates on reserves and resources, we had 159 million ounces of gold in the ground and about 75 million shares outstanding. So when you look at us relative to the industry, we provided far more gold ownership per common share, either in terms of reserves or resources, than any other company on the planet. In fact, we provide 5 to 50 times more gold ownership per common share than anyone else in our industry. And what this has led to is what we were hoping from the beginning, and that's outperformance in our share price relative to gold and other gold equities. As you can see in this chart, since we formed the company in 1999, when gold was trading at about $260 an ounce, our share price at the end of November was up over 9,000% from the beginning. And if you look at those periods of time when gold is in a strong upward trend, like from 2005 to 2008 going into the financial crisis, and then coming out of 2008 to the gold's prior top in 2011, and then again coming out of the bottom in 2015 when gold went from 1900 down to 1050. Owning Seabridge shares in those periods of time is a wise investment to have. It's also interesting to note that if you look at our industry as a whole, our industry has done a horrific job in terms of providing leverage to the gold price. You would think that the producers, as the gold price goes higher, their share price should outperform the gold price in a meaningful way due to operational leverage. However, that's not been the case. Most of the senior gold companies have underperformed the gold price over the past 22 years by a wide margin. In October, I was asked to give a presentation at the Jim Grant conference in New York that looked at the reasons why we believe that the gold industry has not kept pace with the gold price. It's a function of diluting their shareholders' interest in terms of reserves per share, production per share, and also overpaying for transactions at top of the markets and then selling non-core assets at the bottom. On the other hand, we've done things a bit differently, doing our acquisitions at the bottom of the gold markets and growing ounces per share on a consistent basis over the past 22 years. And as Bruce mentioned, along the way, we also found a lot of copper. In addition to 159 million ounces of gold resources in all categories, we also have over 50 billion pounds of copper resources in all categories. And if you look at our pounds of copper per share, either in terms of reserves or in resources, we also provide more copper ownership per share than any of the big copper companies that you may trade in. And we think that as important as our leverage is to the gold price, we believe that as a result of the new green energy initiatives that are being put in place globally, that copper is about to catch a bid and demand that is unprecedented. New mines are more challenging to bring in production, and we believe that as a result of the imbalance we're going to see in terms of new supply coming in and demand that's going to continue to grow, that the price of copper is going to go to multiples of where it is today as well. So if you look at our portfolio of projects, as Bruce mentioned, we're concentrated in North America. This was by design. When we formed the company, we tried to eliminate or minimize political risk, holding our assets either in Canada or the United States. We have 2 advanced stage assets, KSM in British Columbia and Courageous Lake in the Northwest Territories. Collectively, those 2 projects have over 45 million ounces of proven and probable gold reserves and over 10 billion pounds of copper. In 2015, when the gold price hit that low of 1,050 after peaking at 1,900 in 2012, we went back out on the acquisition trail to look for new assets to bring into our portfolio. And we now have 3 new assets, Iskut, 3 Aces, and Snowstorm, which we're now commencing exploration activities on, any one of which we believe can be a company maker. KSM is by far our most important asset at this point in time. It's an asset we acquired from Placer Dome in June of 2000. It's an asset that before we started working on it had $25 million spent on it by previous owners. If you fast forward to today, we've now spent over $500 million at KSM, defining not only the world's largest undeveloped gold and copper project by reserves or resources, but also a project that has successfully gone through the environmental assessment process with permits in hand to start construction, and a project that is endorsed by the key Indigenous groups in and around the project area, namely the Niska Nation and the Tahltan Nation. It's also in an area that's beginning to catch a lot of attention in terms of M&A activity. A couple of years ago, Newcrest came in and bought 70% of Red Chris for a little over $800 million in cash, a small producing copper mine that's now looking for an expansion through a block cave. Earlier this year, Newmont stepped in and bought GT Gold, buying a project that's 1/10 the size of KSM at a price of about $500 million. And just more recently, a few weeks ago, Newcrest stepped in and did their second acquisition in the Golden Triangle, making a friendly bid and announcing a transaction with Pretium, where they'll be buying Pretium for about $2.8 billion in value, combined cash and shares. Another advantage that we have at KSM, in addition to size and support of the Indigenous groups, is what we now have in infrastructure that's been put in place with other people's money. When you look at a project the scale of KSM, you need roads, you need power, and you need ports. We now have all three. A major highway just to the east of KSM, that's year-round access. Along that highway, the Government of Canada has spent over $700 million extending the power grid. We've now sourced, with contracts with BC Hydro, 250 megawatts of power from this line. It's all hydro sourced. We'll be able to buy power off the grid for about 5 cents US per kilowatt hour, some of the cheapest power in the world. And last but not least, to the south of us in the town of Stewart, we have two port facilities, one that's been rehabilitated and one that's brand new. This will allow us to bring supplies in on an annual basis by ship and take concentrate out to a smelter on the Pacific Rim. We are blessed with an abundant amount of resources at KSM. We now have 5 deposits, including the most recent acquisition of Snowfield from Pretium that we completed in December of last year. These 5 deposits now give us 9.8 billion tons of economic resources that are either constrained by open pit shapes or block cave shapes. And these 9.8 billion tons give us 142 million ounces of gold, over 50 billion pounds of copper, and over 700 million ounces of silver. As we went through the environmental assessment process, we are now permitted for a tailings facility that can hold about 2.3 billion tons of spent ore. We have 9.8 billion tons available. So our mine plans up to this point in time have been focusing on what are the best 2.3 billion tons that we can mine to drive the best project economics, recognizing that beyond those 2.3 billion tons, there'll be decades of mine life still left as additional tailings capacities is permitted and put into play. We finished a pre-feasibility study in 2012 that was used as the basis to apply for our environmental approvals. We received our environmental approvals in 2014. In 2016, we updated the pre-feasibility study to show the changes that we agreed to during the environmental assessment process, as well as changing costs, changing metal prices, and changing exchange rates. And as you can see on the slide here, this is a project that has a mine life in excess of 50 years, only capturing 1/4 of the economic resources available to us, and a project that has an all-in cost of production of $670 an ounce, and that's using a copper price of $2.75 per pound and a gold price of only $12.30. This all-in cost of production of $670 an ounce includes all of the upfront capital, all of the sustaining capital over the 50-year mine life, all of the closure and reclamation costs, and all of the operating costs, net of byproduct credits coming from copper and silver. What that mine plan did not include, however, are the new zones we added subsequent to 2016, which found higher grade copper at Deep Kerr and Lower Iron Cap. We've now done additional mine plans showing that as a result of being able to have access to these 2 higher grade copper deposits, that we can show further improvements in the project's economics by taking into account these higher grade zones and filling up the tailings capacity with some ore from these 2 deposits. What we are working on next, however, is a mine plan that will simplify the project going forward and drive economics in a substantial way. and that's through the inclusion of the Snowfield deposit that we acquired from Pretium in December of 2020. This is a deposit that we have tried to buy now since 2008, when it was still owned by Silver Standard. We continued dialogue with Pretium for a number of years, could never reach an agreement in terms of value, and then finally in 2020 we struck a deal with Pretium where we came in and bought this deposit for US $100 million in cash, plus granting them a 1.5% royalty on any ore mined at Snowfield. On the upfront side, we got 35 million ounces of gold. We paid $100 million for it, so we paid about $3 per ounce of gold in the ground. But probably the more important thing is, as we can now integrate Snowfield into the KSM mine plan, we're going to be able to show a project that goes open pit only for decades, pushing back the need to develop the higher capital cost block caves earlier in the project life that's been incorporated in our previous mine plans. And as a result of higher grade gold coming from the top of the Snowfield deposit, a project that will actually go up quite a bit in terms of gold reserves without sacrificing much copper at all, and a project that probably will be able to show in a significant improvement in net present values, internal rates of returns, payback periods, and other important financial metrics. Our updated study is expected to be completed in mid-2022. Over the course of this past year, we spent a significant amount of money collecting the data that's necessary to do the updated pre-feasibility study. We did model confirmation drilling at Snowfield. We did additional drilling at Mitchell. We've now taken bulk samples for metallurgical test work as we plan to combine Mitchell ore with Snowfield ore into the mine blend. And we also did geotechnical drilling to confirm what is the appropriate pit slopes that we can use around the Snowfield deposit. This updated study, as I mentioned, will be completed in mid-2022, and we expect the impact to be very meaningful to the project going forward. Our second large asset is Courageous Lake in the Northwest Territories, an asset we acquired from Newmont and Total in 2002. This project is located just south of the two big diamond mines, Diavik and Ekati in the Northwest Territories, and just north of the winter road that services those two mines during the winter season. At Courageous Lake, we have a resource in excess of 10 million ounces of gold at a grade of better than 2 grams per ton in an open pit configuration. In 2012, we did a pre-feasibility study at Courageous Lake that demonstrated a mine that could produce gold for about 15 years, almost 400,000 ounces of gold production a year. But because at the time the Canadian dollar was essentially at par with the US dollar, which is not good for a Canadian asset that has all of its costs in Canadian dollars, whereas its revenue is driven in US dollars, it showed a marginal project at that point in time with an IRR, pre-tax IRR of only about 7%. If you update, though, the exchange rates and the gold price, the project that looked marginal in 2012 looks very different today. We are now in the process of trying to determine what is the best path forward to unlock value for our shareholders from this project. I'd say in our share price today, there's very little value, if any, for Courageous Lake. And at one point in time, before we started working at KSM, this project generated a market cap to Seabridge of about $500 million US. We are looking at the potential of joint venturing this asset with an established producer, perhaps selling this asset and retaining some sort of gold stream in it, or perhaps even getting back and working on it ourselves once we move KSM forward into a joint venture partnership with a major mining company. I'll next touch on the 3 earlier stage projects we have in the portfolio. We acquired Iskut in 2016 by buying a public company called Snip Gold. We issued about 700,000 shares to buy this. We bought this because we believe it could be another KSM. On the front end came a small deposit hosting a little over 2 million ounces of gold and about 500 million pounds of copper. We are now drilling and vectoring into what we believe is a gold-copper porphyry system there. We've now conducted 2 drill programs looking at this target. We're more convinced than ever that we have these opportunities available to us, and we'll be following up the program we completed in 2021 with further drilling in 2022. Obviously, finding something that could look like another KSM would be very meaningful to our shareholders. The second acquisition we did when the gold market bottomed out after 2015 was buying a large land block in Nevada called Snowstorm. a project we acquired from John Paulson. This project sits on the intersection of the three most prolific gold belts in Nevada, the Getchell Trend, the Northern Nevada Rift Trend, and the Carlin Trend. Our focus here and our target is to find deposits that are similar to Twin Creeks and Turquoise Ridge. We have confirmed now that the structures that lead to those two big mines in Nevada run right into our project area. Last year's drilling, we confirmed that there is gold in the system there, and we are now embarked on another drill program, hopefully to vector in on where the high-grade gold could be here. Obviously, finding a deposit in close proximity to two big mines that will need new ore down the road would be meaningful and impactful to our shareholders. The most recent acquisition we did was buying the Three Aces project in the Yukon from Predator Gold at the height of COVID. It's a project that we've been following for a number of years. It's a large land block. It's over 300 square kilometers with known gold showings about 30 kilometers up and down along this belt. High-grade gold here has been shown in the past. In fact, if you look at some of the historic drilling that's been done here, over 300 holes drilled in the central area, with almost 40% of those holes intersecting better than 5 grams of gold per ton over meaningful widths, and also a lot of high grade above and beyond that. We were hoping to get to drill this project this year. We did a field program here identifying structures to drill that had not been tested in the past, as well as confirming that there is down dip extensions potential to this through deep penetrating geophysics. Unfortunately, we did not receive our permits in time to get the drilling done this year. That will go into next year. And I'd say that of the 3 programs we have next year, this will probably be the largest of the 3 programs going into 2022. So if you kind of try and tie everything together, why invest in Seabridge? Well, a 22-year track record of unparalleled leverage to the gold price. If the gold price is going higher like we think it is, owning our shares should do what they've done in the past, and that's outperform gold and other gold equities. We now have 100% of KSM, which is the world's largest undeveloped gold and copper project. In a world where the big companies need new projects, the fact is they're running out of reserves. They're going to need to start to resupply their portfolios and their pipelines, and they're now starting to look in new M&A activity that's now starting to gel. We made our name through the exploration team we have. Our team has found more gold over the past 15 years than any other company on the planet, and that includes the majors. We now have 3 earlier stage projects, any one of which we believe can drive a value to our shareholders. The addition of Snowfield is going to be impactful on the KSM project, not only in terms of economics, but also in terms of our ability to attract a joint venture partner on terms that we can say yes to. And why are we confident that our time is fast upon us now to get a deal done with KSM? Well, if you look at the industry as a whole, we're running out of gold. If you look at the 1990s, the gold industry essentially more than replaced what they mined every year. For every ounce they mined, they actually found 1.4 ounces in new reserves. The next decade, from 2000 to 2010, that finding was cut in half. For every ounce that they found, for every ounce that they mined, they only found about 0.7 of an ounce of gold. So the reserves are starting to deplete already. And then over the past several years, they're not finding anything anymore. And the fact is they're not spending dollars on exploration anymore, which is another reason probably why they're not finding it. If you look at this chart here, you would expect that as the gold price has gone higher, more dollars will be spent on exploration. And for the most part of the past 30 years, that has been the case. However, a funny thing happened in 2015 when there was a disconnect. As the gold price continued to go higher, exploration budgets went down. Same thing about CapEx. For most of the last 30 years, as the gold price went higher, companies were spending dollars on their CapEx, building new projects, buying new projects. And then again, about 2014, 2015, as the gold price continued to go higher, they were spending less and less on CapEx. And why did that happen? Well, I think the simple answer is our industry was held to task and called to task by some of the bigger shareholders. If you look at the track record of the gold industry over the past 30 years, as the gold price has gone from below $300 an ounce to $1,900 in 2012 and just shy of $1,800 today, There was only 1 year up until recent years where the gold industry actually made money. And that was in that year, 2011, when gold price peaked to about $1,900 an ounce. So you look at a track record of negative cash flow by our industry as a whole during most of the past 3 decades. And then all of a sudden, shareholders started to demand return of capital to shareholders. So what the big companies do, they stop spending on their future. They stop spending on exploration. They stop spending on capital expenditures. And they actually started to generate cash flow because they were not spending dollars on their future. They started to return capital to shareholders in terms of dividends and share buybacks. The problem they have now is they're running out of reserves. The gold industry as a whole has the shortest mine life they have left in terms of mining reserves at the current rate. And within the next 10 or 11 years, our industry will be out of gold. They need to start focusing on what comes next for them. And we believe that KSM represents a unique and an unparalleled opportunity for a major company to step in and do a transaction with us to secure their future. Before we open up to questions, just a couple of closing comments in terms of our capital structure. I think what we're most proud about is after 22 years of building this asset base and growing ounces per share, we only have about 78 million shares outstanding today. That's unheard of in our industry compared to the asset base that we have. I think a lot of that also has to do with how tightly held our shares are. Insiders of this company, and we include Albert Friedberg in that as a founder, own over 30% of the outstanding shares of this company. And then on top of that, we have strong institutional support as well. And then finally, we have a number of analysts that cover us, obviously including Red Cloud, David Talbot at Red Cloud covering us in research. So Bruce, that's really all I plan to speak about, and wanted to get it done in a half an hour total, which I think we've done. So I'm now happy to answer questions.
Terrific. So before I kick them off, I just want to remind everybody on the line, now's the time to get those questions in. Don't be shy. We've got 2 long-term, both gold market experts and mining expert, resource experts here. So, but I'm going to kick it off. Rudy, could I get you just to put up page 40 of your slide again? I'm sorry to, I know you just pulled it down, because this was the first thing I was going to ask you about. This is a really, really powerful dynamic that's been at work. We all know that the large institutional shareholders were fed up with the asset allocation capabilities of the large gold mining companies for decades. You know, Don Cox called these guys out on it for more than 15 years. But the funny thing that I just noticed starting recently, we've now gone, you'll see this green period at the end of the slide where we've gone into this period of the companies making money. And just recently, and I think Agnico kicked it off with the Kirkland Lake announcement, and now we've got Kinross in with Great Bear on this acquisition news. We're now starting to see, I think, the beginnings of what you're mentioning is sort of the next phase, where they play nice for a while, but they realize their very long-term longevity is at question here. So I just wondered if you've noticed anything, given the endowment of projects you have, any change of tone, anything that you're seeing alongside this?
Yeah, absolutely, Bruce. You know, when you look at the kick up, and we've seen this before in our careers, where all of a sudden the window opens for M&A, and the deals that tend to get done first are producing mines. So you had the merger between Agnico Eagle and Kirkland. You had the acquisition, or the named acquisition, of Newcrest coming in and buying Pretium. There's very few big projects available out there that the majors can now step into. There's a few recent ones been done in Australia, but you're now starting to see the turn where they're actually looking at projects that are not yet in production and have a lot of risk associated to get into production. And that's where I think it comes to our benefit with KSM. Yeah, KSM is a big project. It's a $5 billion plus build. There's very few companies that have the financial, technical, and social wherewithal to take on a project of that scale. But they all need projects of that scale. If you listen to Mark Bristow at Barrick, he's actually publicly stating that for the gold industry to remain relevant, they need new big projects focusing on gold copper opportunities in safe jurisdictions. So I think you're right. The window is now opening. The window is, and it has to open because, you know, one of the reasons, higher gold prices led to this these nice green numbers at the end of the slide. But also these green numbers were driven by not spending on CapEx or not spending on exploration.
Burning the furniture along the way, right?
Exactly, consuming themselves in the process. And you look at Barrick and Newmont. Last I looked, they have about 10 to 12 years of reserves left. They've got instruments out there, financial instruments that go out 20 years. There's a mismatch there. They're going to need to start to really focus on what comes next. And I think that's really where KSM jumps in terms of an opportunity that, in our view, there's nothing else out there as good or as advanced as this that can. I mean, KSM, when built at today's metal prices for the first 10 years of mine life, will generate over $2 billion of cash flow a year.
That's right. Well, Rudy, there's one other thing I think important that came up in your conversation, because I hear Dave Talbot at my shop and others saying it on a regular basis. It's one thing to have an interesting looking resource, but there's a timeline that these majors need to get them into production as well. And I think that the markets don't particularly understand how difficult and how long it takes to actually put something into production, given their futures, right?
When I started my career and started building mines in Central America, we essentially were able to permit mines in less than a year. I mean, you look at KSM today, it took us we started the environmental assessment process essentially in 2008 with our project description document. We didn't get it approved until 2014. That took 6 years. It's a lot tougher today than it even was back in that time period when we permitted KSM. A project the scale of KSM takes upwards of a decade just to go through the environmental approval process, whereas a generation ago you could do it in a couple of years at the most.
No, agreed. Jim, I'm going to give Rudy a break for a minute because he's been talking for a while here on Seabridge, and I just wanted to talk to you a little bit about your gold price. If what you're saying is going to happen, my first question is if that second shoe is about to drop. Generally speaking, it's going to require that the Fed either slow down their progression in bringing on rate hikes or even alter their situation. And from my recollection back in 18 and other periods, usually the markets have to get quite nasty. The capital markets have to really seize up to varying degrees to get the Fed to really change their mind when they've got their course set. Any comments as to what we can anticipate going into next year?
I think, Bruce, everything happens faster now. If we look at the last attempt at a tightening cycle, which had to be aborted, that's the one in 2018, the initial sense of it was, okay, this can happen. And, the market actually allowed the tightening to get fairly advanced before everything seized up. And by everything seizing up, I mean that, first of all, I think there was something like 57 days in the fourth quarter of 2018 when not a single high yield debt deal was done, and the S&Ps dropped 20%. That was an obvious liquidity issue. And then the Fed did step in and turn it around. First of all, they stopped tightening, and then they came with $1 trillion worth of repo liquidity to bail the situation out. So the Fed learned something from that, and I think so did the market. This time around, and you can see this each time out, in fact, stepping back for a second, every recession has started with Fed tightening. So why should this be any different? But this time around, I think we're all on trigger fingers. We're going to see, and we're already seeing, some decreases in liquidity because the market's actually doing the Fed's job for it. The Fed hasn't started tightening yet, but the market is signaling 3 rate increases next year. That is tightening, and it's adjusting behavior in the market already, as indicated by the indications of tightening liquidity that we've already seen. So I think this is going to unwind very quickly. The Fed is actually showing a fair bit of courage in stepping into this trap again. They know they need to pull it off if they can. But I think they're also quite willing to bail at a very early stage this time and recognize that inflation is with us. And they have the support of the administration in Washington to take that view, where if they actually do start tightening, you're going to see real kickback from Janet Yellen and the Treasury. So there are a number of things here conspiring to prevent the Fed from getting very far down this road. And I would guess that in the first quarter of 2022, we're going to see a make it or break it attempt to maintain this narrative of tightening, and it will fail. We're already seeing the signs that it will.
Just as a quick follow-up to that, Jim, is it possible that the tapering itself, long before we ever get to any type of rate hike, could the tapering itself create this liquidity event that would force them to back off?
It could
without rate hikes.
It could have, but the Fed was very clever here, and it tells you how careful they're being, and I would say nervous, because the Fed just a few months back now formulated two new permanent liquidity providers in the form of a foreign bank repo facility and a domestic bank repo facility. Both of those are sitting there as methods for investors and the market itself to gain short-term liquidity if they need it. So they've protected themselves on the tapering side of things. I didn't personally anticipate that, and I thought tapering would, in fact, bring about a defeat of the whole tightening process early on, but it hasn't. The Fed has managed to announce and begin the tapering process. However, I think that's because the short-term liquidity issue has, in fact, largely been solved. So I think it'll take the threat of tightening, of real tightening, that is, raising of rates, to get the market to a sufficient degree of panic that the Fed will back off. I think that's inevitable.
Thanks, Jim. So Rudy, over to you. Question here. Are on KSM/Snowfield, do you think some of the parties you're in discussion with are waiting on the studies to come out mid next year before they get too serious with you?
No, I mean they've signed CAs. They have all the data available themselves. They can run their own mine plans. I think what they're waiting on more is the ability to actually get boots on the ground and do site visits. I mean, let's face it, for the past 2+ years, Canada's pretty much been shut down. And it wasn't until September that Canada really opened up that you can bring people from outside of Canada into KSM without having to quarantine for 2 weeks. So I think a big part of it is more driven by accessibility to the project where they can get the boots on the ground versus the data. So I don't think they're waiting on that. I think it's more getting the proper due diligence they need to check the boxes on. One other thing I will point out in terms of why we think Snowfield is a meaningful addition to the project. If you looked at all of our mine plans up to this point in date, including the 2016 PFS, those mine plans included to start block cave development in the first 10 years of mine life. That brings a lot of capital in the first 10 years of mine life that has to be spent on block cave development. There's very few companies in our space that had block caving capabilities to that scale. In the gold space, it's only Newcrest. Newmont Barrick has never block caved. In the copper space, it's Freeport. BHP has never block caved, and Rio Tinto is having their head handed to them right now in Mongolia. What we're going to be able to show with Snowfield, and the companies already can see as they do the work themselves, is block caving goes 20 to 30 years into the future without the need to spend that capital up front. You can imagine a corporate development team taking an opportunity like KSM that involves $5 billion of upfront capital or more to build a mine, and then more project development capital for block caving in the first 10 years of mine life, to a company that doesn't have any block caving history whatsoever.
Too much.
Yeah, Snowfield, 30 years open pit if you want it. If you want to go after the high-grade block caves with copper, they're there as optionality for you as a mining company.
And because of that, has it changed who you're potentially dealing with?
Absolutely. So, if you look at companies that did not have any block caving experience, kind of shied away from the project pretty quickly. Those companies are now back in a big way in the data room with us because they now see a pathway of open pit mining to the end of their careers that they don't need to worry about block cave mining. So absolutely, there is a positive impact with companies that may have walked away in the past that are now back because of open pit only. There's a lot of companies out there, they just call themselves sunshine miners. Well, we now have sunshine mines for 30 years if you want it.
I understood. One more for you, Rudy, before I go back to Jim. Copper prices, they've remained remarkably stubbornly high, given all the naysayers about prices rolling over. Have you seen, when you've been dealing with some of the major companies, a belief more recently that the longer term future of copper is quite robust? When they
Absolutely. I mean, these analysts that build these supply and demand models, they build mines on paper very quickly before realizing how long it's going to take to bring new production to the forefront. The mining companies that have to build these mines recognize the challenges they have to bring new capacity to the market. I think probably the best study that's been done on the copper supply and demand fundamentals was a study done by Goldman Sachs earlier this year that showed that by the end of this decade, we're going to have a cumulative deficit in the copper market of pushing 30 million metric tons of copper. Just think about that. In the year 2030 alone, like 9 million tons of copper.
Well, isn't the current copper market only 24 million metric tons?
Exactly. Yeah, this is a cumulative deficit over that time period. The fact is new production is hard to bring forward. As we mentioned earlier, it takes a long time to get projects permitted. The projects that may be on the drawing boards are challenged because of lack of power, lack of water. And our industry is also challenged right now by lack of people. I mean, we're trying to hire people to help in terms of activities we plan to do at KSM next year on the ground. And it's a challenge to find capable people in this market as well.
Yep. I'd also add political risk hasn't really gone away either in a lot of jurisdictions.
I don't know if you saw the announcement this morning on
I did.
Yeah. Yeah.
I did. Jim, back to you. All this talk on inflation, there are those out there saying that inflation's printing at the highest point that it's done for decades, which is obviously true. But they are either calling for a dramatic slowdown, if not a rollback to, I'm not going to suggest that inflation's going back low, but they're saying that it's going to moderate here. And there's this, they're suggesting some of the commodity prices out there, for example, whether it be lumber, even energy sort of rolling over a little bit here. And the fact that some of the ports are slowly but surely starting to get themselves and goods to end markets as the rationale for inflation may be hitting its marginal peak, if you will, even if it's not its absolute peak. Any thoughts on that?
Yeah, there has. Those who argue that inflation is transitory were relying a great deal on the supply chain difficulties and transportation issues for their arguments. But if you look at the CPI data, we've gone way past those issues, and we're now getting very widespread inflation measures in all kinds of things. So if you listen to, an earnings call from a Procter and Gamble, they will tell you that their biggest challenge is all the inflation inputs that they're getting and how they are going to and at what rate they are going to raise their prices to gain back margin. So margin retrieval is now the big issue in the corporate world.
PPI creeping into CPI?
Yep, that's right. So I don't think we have to worry as an industry, as a gold industry, about inflation disappearing on us. And one other factor to look at is the way CPI is calculated. there are some key issues about how it's done, in particular, the rent issue. Rents, as measured by independent industry organizations like Apartment Inc., indicate that rents in the last year in the US have, on average, gone up 15.6%. However, the CPI recognizes only 3.1%. Gradually, over time, the buildup in inflation in other areas, such as rent, will factor in. We're also beginning to see inflation in wages, and that's where inflation does become self-sustaining. Is when there's an effort to catch up to the inflation that's already occurred. So you get a leapfrog effect that tends to continue well after the original impulse. So, I don't like to say this on behalf of the ordinary consumer, but I think inflation's going to be with us for quite a while. The genie's out of the bottle. It's very hard to get it back. Also, I would point out that the inflation effects of China are now beginning to tell. We used to think that China was a deflationary impulse within the global economy, but now they have decided that their attempt to control inflation is not a good thing, and they have dropped their reserve rate twice in the last 6 months, and they've also begun a new round of credit impulse to get the economy moving again, which will be inflationary. And their wage rates are rising very quickly. So I don't think we're going to see the moderating effect of China as we did in 2008 and 9.
Okay. Jim, one other thing before I go back to Rudy, that I'd be remiss if we had a gold commodity discussion without talking about currencies, Bitcoin or blockchain in the conversation. So just wondered your thoughts. Many commentators and people out there talking about the fact that the Bitcoin or BitCurrency market has taken a bunch of the capitalization that would in normal cycles have made their way to gold. And has it really changed the game for gold here going forward?
Our sense is not. There's enough room for both. If people are avoiding the gold market right now because of concerns that the Fed is going to deal with inflation, I don't think that has much to do with Bitcoin. Not only is there room for both, but they do, in fact, draw different investors. So when you look at Bitcoin, it tracks very well with the NASDAQ, with NDX. It's a speculative thing, and it tends to have very volatile moves based on underlying markets like the NASDAQ. Whereas gold is not dependent on the stock market or other evidences of inflation to the same extent. Also, you can see that central banks are buying gold. They're not buying Bitcoin. And gold has an industry that employs hundreds of thousands of people. There are companies that have cash flows that you can invest in, and you don't see that in Bitcoin. So they're really quite different markets. One of them is risk on. I would say that's Bitcoin. And one of them is risk off, which is gold. If we're going into a risk off period, and we think that's what's going to happen here with the failure of the Fed to deal with inflation, then it's going to be a new ball game, and we'll see which performs better. But as I said, there's room for both, and they attract different investors, so let them be. They're not enemies.
Thanks, Jim. Rudy, I'm going to save the last question for you. I think it's a good time to ask, if you look at your earlier stage children, those are your earlier stage projects, what are you the most excited for 2022's exploration programs? Which gets you the most excited in the board?
I'd say probably three aces, in that if you look at the historic drilling that's been done there right near surface, tremendous grades, multiple meters width. We believe that they missed the down dip extension of those high grade targets, and we also believe that the previous owners missed that there are actually parallel structures there that should have the same type of potential. It's unfortunate we did not get to drill there this year, but I think of the three we have now, three aces in my view, is the most exciting.
Terrific. Well, listen, on behalf of Red Cloud, we're running into almost an hour here. We really appreciate both of your time. Thank you for wrapping up the late call for Seabridge for this year. We're looking to having you guys back early next year.
Thanks,
Great.
Bruce. Thanks for everyone for attending. And if you have any follow-up questions, please don't hesitate to shoot me an email, Rudy, R-U-D-I, at seabridgegold.com. In the meantime, have a happy holiday season.
Thanks, Rudy. Thanks, Jim, and thanks, everyone.